Welcome to Stock Shotz. We're so pleased to have back as our guest today, Carley Garner of DeCarley Trading. Please visit her website at decarleytrading.com. That's www.decarleytrading.com.
Carley, thanks for being back with us on Stock Shotz this morning.
No problem. Glad to be here.
Carley, how important is today's CPI number to key technical levels on both the Dow and the S&P?
The market's been contemplating the Fed action going into 2009, along with debate over whether slow growth or inflation is the biggest obstacle. So despite light volume, today's numbers will certainly be heavily considered by traders. The recent burst of the so-called commodity bubble has taken some of the edge off of inflation worries, but the implications are still lingering in the back of everyone's minds. Crude oil may have dropped $30+ from the highs, but in today's markets, everything's considered temporary and nothing's taken for granted. I think we might get a reaction on the number today.
Talking about crude oil, do you have a sense of whether or not we started to hear the bubble talk when it dropped to $30+? And I think yesterday kind of made everybody start to rethink that. We saw all the commodities begin to kind of tick up. Do you think we return to a long-term uptrend, or do you think we continue downward?
I think the commodity markets have a funny way of flushing out position traders that simply get too comfortable, and I think that's really what we saw. We recently witnessed many of the same long futures-only funds that drove commodity prices to unfathomable heights get forced out of the market in the blink of an eye. The magnitude of the moves involved were extraordinary, but the price action itself was relatively common for these markets. Crude oil has taken quite the beating and seems to be a little bit oversold here. With that said, I'm looking for a bounce to about 122 using the September contract as a reference. However, my models are showing that if we do break support near 111, we're headed for $100 a barrel. What once was psychological resistance will now be the heavy support, and it'll be interesting to see whether the market's going to be able to penetrate that level on the downside or not. Fundamentals seem to have run their course, in my opinion. Aside from a corrective bounce, I remain bearish in this market.
So you're bearish down, but you think 100 is going to pretty well give some strong psychological support?
I do. I mean, I actually think we're going to get a little bit of an upswing here just in the near term. I think we've dropped a little too far, a little too fast. But from there, I definitely turn into bear, and I think we're going to see 100. Whether we break it or not, I'm not sure. But I think we'll see it soon.
Let me ask you one other thing. I put out a post probably 4 or 5 days ago on my blog, and I said, now may be the time to pick up some cheap gold. And I got some pretty heated emails from people who think, the dollar is going to rally and gold's going to fall. I was looking at support around $800 on gold. Again, I'll ask the same question that I asked about energy. What do you think happens to gold over the short term?
Okay. I'm kind of in the, as you know, they're correlated. I'm kind of in the same boat. Gold, I look at a gold chart and look at the fundamentals, and to me I see a market that's clearly, we've clearly had a considerable correction. And just from a technical standpoint, I think we're going to see either some short covering or some bargain hunting coming in here. I'm looking for the December gold to bounce to about the 900 level before continuing lower.
Okay. That would provide a pretty decent short-term bounce.
That would. That'd be a sizable move.
Do you have a favorite trade going into the CPI number? Do you try to get in front of things like this, or do you just kind of play wait and see with a big number like we have today?
I try to be as conservative as possible. Like you said, money management in these markets is very important. Ahead of the CPI report, I'm looking for opportunities to sell call premium against a large spike in the long bond. The market's experienced several large ranging days, but hasn't really made a lot of progress throughout the week. This tells me that there may be a lot of pent-up momentum looking for a reason to be exposed, and this might be it. If there's a knee-jerk reaction to the report on the upside, it's likely that buy stops placed above recent resistance levels will be triggered, sending the 30-year bond to perhaps the July highs, which would put them in the mid-117 range. If I'm right, it might be possible to sell distant out-of-the-money call options for top dollar in hopes that the volatility will soften and ultimately the direction of the market will change. I've got my eyes on the October 121 calls for 20 ticks, which is about $312. So in other words, we're looking to sell the 121 calls for a little over $300. This is a base hit strategy as opposed to a home run play. It won't make anyone rich, but the idea is to put on high probability trades and hopefully not run into any trouble. However, as you know, anytime you're selling options, there's unlimited risk. So while the odds may be in your favor in the long run, you have to handle the positions with care.
Well, I tell you what, right now, a good base hit strategy is the way to go, in my opinion, because I swung for the fences a couple of times earlier in the week and struck out. So,
there you go.
A good base hit strategy has some value right here. Let me ask you one other thing. We've talked a little bit about volume being light. Do you adjust your methods, or do you lower stops or run a longer range, so to speak, when volume is light, or make any adjustments to your strategies?
I tend to focus on options as opposed to futures or buying any contracts outright. But like in my case, I'm a big advocate of option selling. Liquidity matters regardless of the strategy, clearly. But as an option seller, many markets are off limits even during heavy times of trading. The thinner the market is, the wider the bid-ask spread becomes, and the more difficult it is to overcome the transaction cost. In other words, there's less room for error, and the profit margins diminished. My markets of choice are the stock index futures, such as the S&P 500 and the Dow, as well as the Treasury complex. Each of these markets are liquid enough and provide efficient execution even during lackluster volumes, such as we're seeing today. So the strategy itself doesn't really change, other than you have to exercise a little more patience, and limit orders are a must. Market orders can get you into trouble in these types of markets.
That is definitely true. Now, prior to yesterday, we were seeing just some awful selling in the ag names. I mean, I haven't seen a rollover like that in quite some time, particularly with the fertilizers. Potash, CMP was a stock that, Compass Minerals was a stock that I had owned up and down during this cycle. We saw John Deere miss earnings yesterday, and then these stocks popped back yesterday. What do you think about the ag complex?
Okay, I typically don't follow the stock. I typically follow stock indices closely as opposed to individual stocks or sectors, but I do follow commodities, and there's definitely a large correlation between the price of agricultural commodities and the stocks that you've mentioned. I mean, just as you mentioned yesterday, the stocks had turned around sharply. Well, so had commodities, and I'm sure that had a lot to do with it. With that said, commodities are still relatively high compared to historical standards, and certainly have some room to move on the downside. Once again, just as with gold and with crude oil, though, in the near term, we might be due for a corrective bounce higher. I see the agricultural stocks will likely benefit in that in the coming weeks. From there, obviously the direction is up in the air, but I still tend to be a bear. So if that helps you.
Yeah, well, and I would interpret that if we do get a sharp bounce, which it seems like these days there's everything is sharp, then maybe one could position themselves, if they were a bear on that sector, they might sell some calls on some of those high-flying names and maybe pocket some of that premium.
Exactly. That would, obviously it depends on market conditions, but yes, that'd be something that I would definitely look at.
For the rest of this great interview, visit our website, www.stockshotz.tv. That's www.stockshotz.tv. Thank you for listening.